We need to talk about a financial trap that catches so many well-meaning families completely by surprise. It starts with something you've probably done or thought about doing, but it can create a permanent problem with the IRS. Let's dive right in. So picture this. It's a really common situation, right? You and your spouse, you want to help out your child, maybe with a down payment on a house. You've got a joint checking account, and one of you just writes a check for, say, $30,000. To you, it's a single gift from both of you. But here's the thing, the IRS sees it very, very differently. And this is the fundamental disconnect. In your mind, you both gave 15 grand. But in the eyes of the IRS, especially if you live in a common law state, all that matters is whose signature is on that check. That person is considered the sole donor of the entire $30,000. This is what's known as the check signer rule, and it turns your joint gift into a single, much larger one. Now, why is this such a big deal? It all comes down to this number. For 2025, any person can give up to $19,000 to any other person without needing to tell the IRS a thing. It's a free pass, basically. And it's a really important threshold. So let's do the math the way an IRS agent would. Parent A, the one who signed the check, is on the hook for a $30,000 gift. They get to subtract their $19,000 exclusion, sure, but that still leaves an $11,000 taxable gift. And what about Parent B? Well, as far as the IRS is concerned, they gave nothing. Their entire $19,000 exclusion for that child just went to waste. Just like that, a simple signature created a taxable event that has to be reported. Okay, I know what you're thinking. So what? The lifetime exemption is huge, almost $14 million in 2025. I'll just use up a tiny piece of it, no big deal. No tax is actually due right now. And look, you're not wrong. For most people, there's no check to write to the Treasury today. But that's what makes this so dangerous. It creates a false sense of security, because the real penalty here has nothing to do with paying immediate taxes. And this is the real kicker. The danger isn't a tax bill. It's a procedural time bomb that you've just set. By not reporting that taxable gift, you open a door for the IRS, a door that can never be shut again. Welcome to what some tax professionals call the infinite audit. You see, under the law, the IRS usually gets 3 years to audit a return once it's filed. A clock starts ticking. But if you make a taxable gift, like that $11,000 excess, and you fail to file the required Form 709, that 3-year clock, well, it never starts, ever. The transaction stays open season for the IRS, forever. So let's see how this plays out. It's 2025, you write that check, you don't file the form, and you forget all about it. Now, let's fast forward 30 years. It's 2055, the person who signed the check has passed away, and their estate is being audited. An IRS agent is digging through old bank records and finds that check from 3 decades ago. Because that audit clock never started, they can absolutely challenge it, and now they can assess back taxes, penalties, and interest directly against the estate. That little mistake from years ago is now shrinking the inheritance your family receives. All right, so how do you avoid this nightmare? The good news is the easiest fix is incredibly simple. You just have to be proactive. Instead of one big check, you write 2. Parent A writes a check for 15 grand. Parent B writes a separate check for 15 grand. Boom. Both gifts are under the annual limit. No one has a taxable event. No forms need to be filed. Problem completely and totally avoided. But what if you're watching this and you're having that sinking feeling because you've already written that big check? First, don't panic. There is a way to fix it. You need to file a gift tax return, an IRS Form 709. On that form, you make what's called a gift-splitting election. The non-signing spouse signs it, consenting to treat the gift as half from them. This officially tells the IRS it was $15,000 from each of you, and, most importantly, it finally starts that 3-year statute of limitations clock. Now, before everyone panics, it's really important to know that this whole check signer trap is not a nationwide problem. It's mostly a thing in common law states. There is a huge exception that depends entirely on where you live. Right. So, if you live in one of these 9 community property states, the game is totally different. In these states, the law basically presumes that any money earned or assets bought during the marriage are owned 50-50 by both spouses. So, a gift coming out of a joint community account is automatically treated as coming half from each of you, no matter who actually signed the check. So if you're in one of these states, this particular trap usually isn't something you need to worry about. So when you boil it all down, what's the real lesson here? It's simple. Your intentions are worthless to the IRS. They don't care that you meant for it to be a joint gift. All they care about is the procedure. If you don't follow the rules, either by writing 2 checks or filing the right form, your good intentions just don't count. And that really brings us to the final question you should be asking yourself. This whole financial legacy that you're working so hard to build can be chipped away by these small, simple, and incorrect assumptions. So it's worth taking a hard look. Are the generous things you're doing for your family actually protected? Thanks for tuning in.